As we all know, we like to kick off with the product supplied summary tab. And here you can see that we got that spike, which we normally got, which we got in 2021. You can see that we had it in 2017, 2018, and that is driven based on, again, people moving about, obviously going away for the holidays. And because we had Christmas on a weekend, we had New Year's on a weekend, a lot of people took that whole week off. So you had that big surge. Then that drop, then you'll get a little bit of a bump on the back end. But you can see here, when you look at it now, and you saw it in 2021, you had the spike and then that big drop. Well, this drop, just because we were starting from a lower point, the drop up, the spike up was lower, the spike down was more. And then obviously you had weather factoring in, which is making that drop down more extreme. But as we get to the other side, you'll get a little bit of a makeup number. But then when we look at how we're going to kick off Jan, you could see in general, and this is going back to 2017, you start off at a fairly weak point because January is a very slow month. You know, you have people that are just, I personally don't like January. I love Christmas so much and the December period so much that it's kind of like this little like mini depression before we come through. And then I actually like February because we get some decent snow. And so those are some little pieces. So now when we look at where we are, we're going to have something very similar. When you look at where we sit, where we're going to start at the low end, obviously something closer within the 13.5 million. But then we'll get that spike and we expect to be something closer to 13.8, 13.9. And again, it's just we don't expect a big bounce in gasoline. We expect gasoline demand to be fairly weak at this point. And then the same to be on the distillate side, just because we don't have the trucking backlog. We don't have the trucking supporting us. And we did get that warm up, which is going to reduce heating oil demand, which again is going to keep us on the very low end of the demand cycle to kick off the year. So then when we look at distillate, you had a draw of 1.43 million. That's 16.5 million below the 5-year, 8.1 million below last year. And pad 2 was the biggest driver with a drop of 2.28 million. But pad 3 is actually fairly normal and actually above where we were in 2021. And a lot of that was driven, the draws out of pad 3 were driven based on an increase in exports and that drop in refined activity, which means that they had to pull out of storage. Imports came down a bit. They were down 140, they came down 47,000 barrels. And when we look at pad 1 continues to be the problem. Now, the warm up is going to help pad 1 a bit just because you're going to have less demand on the heating side, and that's going to allow a bit more backfill. So we should actually get a little bit of a reprieve as we go into the beginning of the year in pad 1. But when we look at margins have come down a bit. You know, as we've been saying, we expect it to be fairly range bound. Gasoline is a big overhang. We do expect to see a little bit of softness in the diesel crack, especially as we get this warm up coming through. So realistically, it could come right back to about 42 to 45. Excuse me, and then hang in at the lower end of that range that we've seen at the back half of 2022. Pad 1, here you can see we closed out the year at new all-time lows, and we expect to kick off the year at new all-time lows. But then you'll see a little bit of an improvement. Typically, we start out higher and then drop down with getting to the low point that is normally in March and April. Then again, that's usually because that's when we go from winter to spring, and then you start to see those builds. You know, pad 1 is going to continue to struggle as they have to go into the Atlantic Basin to pull in the difference. The other side of the equation is, as we said in segment 1, you have Colonial Pipeline, which is now shut between now and Saturday, and that's also going to impact pad 1 because they're not going to get that natural flow coming through the Colonial, which will impact this and actually bring storage lower. That should fill up fairly quickly, and I should say repair itself fairly quickly. And then when you look at the demand side, that's also going to help. So we do have a supply issue, but we also have some of that weakening demand. When you look at pad 3, things were fairly normal. Again, a lot of this is driven by exports. A lot of this, some of this was driven based on the cold. Now we expect to see this move back higher just because distillate remains the target. That's where you're making any kind of margin because gasoline continues to be an underlying problem. And this just puts into perspective just how steep that drop was in distillate. You can see that it's happened on multiple times before. A lot of them are usually weather related. Here we had another one closing out at the lows. We expect to start off pretty much in line with the seasonality as we go into the beginning of Jan. And then depending on how the warm-up remains, we should actually stay below the 5-year average and at the lower end of the cloud, just because trucking is a problem and is going to stay a problem, and then you don't have that heating oil demand. And this is looking at the trucking side. You got a little bit of a bounce here. But again, there was a bounce. A lot of that is just off of the holiday season. We expect this to come down a bit and settle in between 45 and 48 as we go through the rest of Jan. When you look at rail traffic, here you can see rail traffic started out fairly weak. When you look at it in terms of the total car loads, I should say end of the year, total car loads were down 12.5%. A lot of this was just driven based on weather issues, as well as just that, the slowdown into the end of the year. We do expect things to pick back up on the coal front, on the grains front, forest products, as well as on the petroleum and petroleum products. Motor vehicle, they're going to continue to try to catch up. And then intermodal, we expect things to remain fairly stable and a little bit at the higher end, just because you will have some companies looking to replenish some of the inventories from the end of the end of the Christmas season. But when you look at the amount of sales, the amount of inventory, there is a lot of inventory out there. There is a lot of that disconnect, which is going to be an underlying problem. So again, that's why intermodal will be better, just not as good as really I think some would hope. And this is another reason why, when you look at vessels coming in, you can see that things are well below where they were previously. You have fairly average wait times. You don't vessels within 40 nautical miles is 0. Total vessels due coming up is inbound is 4. Again, very normal, if anything, on the lower end. So this is where we keep talking about the issues that are progressing. Because this is, again, when you look at trucking, you had a little bit of that bump, but when you look at what's coming into the market, there's really nothing exciting or showing that there's going to be this big increase in trucking demand in the near term. And then here's your look at heating oil and natural gas with things above normal, pretty much across all of the U.S. And that's something that is going to persist into at least the middle of January, until we should get a bit more cold coming through the seasonality. Gasoline had a small drop of 350,000 barrels. That was driven based on Pad 3, which had a drop of 4.06 million. And again, a lot of that was driven based on the cold, because you had a reduction in gasoline production, with refiners shutting down, and that resulted in draws. Pad 1 had a big build of 3.08 million. As we were saying previously to before we went on break, we saw a big slug of European product coming across. A lot of that has been hitting, and we've continued to see those imports remain elevated, and that should remain the case. Pad 1 has repaired itself pretty quickly. Pad 1 had a big build of 3.08 million, and that brings us only 4.7 million below the 5-year. And again, a lot of that was driven because we had a big slowdown in demand. We had a lot of inclement weather up and down the eastern seaboard, throughout the Midwest, so into Pad 2, and then through Pad 3. So again, not a lot of activity. So that's when you look at storage, closed out the year fairly flat on the higher end, and we expect that the builds to accelerate as we kick off the year, because we don't see a big bounce in demand. And this is just one of the things that we wanted to talk about, just because, one of the interesting pieces, and Bloomberg had an article on it, where miles driven were actually higher than normal, but yet demand was less. And if you think about the natural progression of just new cars, the average age of a car in the U.S. is about 11.3 years old. So if you think about that, that puts you right at around, 2012, 2013, when you really started to get a big focus on miles per gallon, and that has only become a bigger focal point. So you have just more, on average, more efficient vehicles, and you have the hybrid work schedule, which is really becoming more impactful, as we said it would back in 2020, because we never believed that work from home permanently was going to be a thing. We thought more of it was going to be more accepted, where, you know, as you can see, pre-pandemic, 8% of correspondent or people responded thought that they wanted to work exclusively from home. Now you have 34%. Again, neither one of them is going to be right. You know, it's not going to be 8%. It's not going to be 34%. Realistically, we think it's going to be between 20 and 23%. But then when you look at the hybrid schedule, 32% of people expected it, 60% now expect it, and 60% is actually something close to what we think is going to stick, purely because, and then you can see the breakdown, current hybrid schedule, most people have 1 day on site or 4. That's why on average, we're saying that there's typically 2 to 3 days of people on site. And that, again, reduces the amount of driving that is being done during the work week. And you might think it's like, well, people might want it, but managers don't. But then when you look at managers, you're starting to see that, you know, 2 days per week is accepting by workers, hybrid leaders, managers, individual contributors. And that's where we see a fairly consistent component. And you can see 2 days and 3 days is very common. And that's where we think that is going to get that kind of move down in gasoline demand. Not a collapse. It's just that move up is not going. We've had a continuous trend since 2012, you know, of just gasoline demand ratcheting higher. And what we've been saying, and what I had been saying since about 2018, was that as you got new cars coming online, you had that cycling out, you were going to see that level off, not drop by any means, but just level off. You know, I did not expect the hybrid side to, or the hybrid work schedule to get adopted to the level it has. But now that we're here in this new normal, I think you will see that take a step down. And but again, we're not going to crash in terms of gasoline demand. It's just we're going to be fairly stable, and it's going to go fairly sideways after we get some more repairs to gasoline demand. Obviously, now we're facing last year we were facing pricing. Now we're facing a recession. So again, you're going to see some of that underwhelming data. But even when we start getting back to a more normal economy, we don't expect it to go back to where it was previously. Blending components was projected. We were projecting to close out the year on the high side. That got disrupted, obviously, with the cold snap that shut down refining capacity, but you can still see it closed out the year on the high side. Now, when you look at Gas Buddy expected the year to close out at 7.5 million barrels a day of demand, and they called for 7.54. And it's interesting because the EIA came in with 7.51. So again, right kind of in line with where we are. We do expect a bounce to about, let's call it 8.5, 8.4. And that's something that we think is very likely. According to Gas Buddy, gasoline demand fell 13.7% and was 12% below the 4-week average. But even for this week, things are still on the weak side, and that's something that, again, kind of speaks to the problems we expect in January. Now, here's the quote from the Bloomberg article. Rising fuel efficiency allowed U.S. drivers to cover the most ground for any October while using less gasoline than in just about any year since 2013. October gasoline consumption was the second lowest seasonal level in a decade at 8.83 million. Meanwhile, total vehicle miles in October was the highest on record for the month. So again, U.S. fuel economy hit a record high of 26.36 miles per gallon. And that's just giving you an idea of some of the impacts of fuel efficiency as well as we move into the hybrid schedule. Here you can see the sizable collapse in congestion. And again, all of this is seasonal. It will snap back, but you can see in Jan, it takes a little bit of time just because typically January is a much slower month. Now, in China, we did get a bit of a recovery, but as we've been saying, the recovery was going to disappoint to a degree, just because it's going to take time for COVID to work through the system, everything to start to reopen. So we don't see a bigger reopening impact and getting above where we were pre-COVID until we get closer towards the end of January. Prices bounced a bit, and you could see that there's some stability in diesel here. We think it'll just kind of hang out at this level. Obviously, that the headwinds are the slowdown in heating oil demand as well as trucking demand. Tailwinds are obviously the shortage in storage and just the levels that we're currently at. And gasoline had a bit of a bounce, but we should see that level off as well and actually start to come down a bit. Here, again, just looking at gasoline demand, you can see it drop through the floor. It's well below where we were in 2020. A lot of that is weather related. We should get that bounce back, but we don't expect it to be all that exciting and be closer to where we actually started the year in 2020. I'm sorry, in 2022. It'll obviously be above where we were in 2021. But again, we think essentially above the green line, but below where we kicked off the year. Propane, propylene had a draw of 3.75 million, still 9.7 million above the 5-year. And you had that drop just because you had that cold snap that was recognized here. But you can see that the slope is strong, but it's no different than any other year. So we're going to start off with a fairly sizable amount of propane in storage. Jet had a drop of 2.15 million. That's 4.2 million below the 5-year, right around where we were year over year. But you can see on the demand side, we had that spike, which we typically do. Then we have that continuation as we have that jet fuel moving through to make sure that there's enough for flights. And then we're kind of back to that normal level. When you look at US TSA checkpoints, you can see for 2022, we were about 93% of 2019 levels. And you can see that we've been fairly stable there. And then when you look at Eurocontrol flights, we're at about 88.5% of 2019 levels. And again, we don't expect that changing in the near term. When you look at recent, you can see that we're just hanging out right where we were in 2019, 2020. And we don't see that changing as well, especially when you look at flights. So the 12 weeks ahead, the flights were lowered 1.46%. So again, you had that spike coming into December and now or into the holiday travel, and now things are slowing down once again. Open table, you had a lot of activity during the break, and now we do expect to see that slow down as well along economic lines, seasonal lines. But again, you're going to see that come back, closer to normal, maybe probably 5% below normal, but again, fairly stable for Jan. Now, in the next segment, we're going to go deeper into global, what happened with Saudi, the OSPs, and how have things shifted, as we head into January and February crude sales.